Thanks very much, and welcome, ladies and gentlemen, to the launch of the IEA's Medium-Term Gas Market Report 2014. It is an honor and a pleasure for me to introduce our main speakers today. Maria van der Hoeven is Executive Director of the IEA. Laszlo Varro is Head of the Gas, Coal, and Power Division at the IEA. Ms. van der Hoeven will speak, give some brief introductory remarks about the report, and will then hand it over to Laszlo. After Laszlo walks you through some of the details of the report, we will make time for your questions. Ms. van der Hoeven, you have the floor.
Thank you very much, Greg, and good morning or good afternoon to all of you. And it's a pleasure to be with you to launch our medium-term gas market report. And, you know, the IEA's medium-term reports differ from our more policy-focused publications because they look out over a 5-year horizon and they ask the question of where current investment activity based on current policy settings will take us. Now, sometimes we like what we see, sometimes we don't. But these reports show where we will arrive if we don't change direction. So if you want to be in a different position than that is projected now, you have got to change your policies. Now, a week from today, we will release our oil report, and our renewables report will come in August, followed by coal towards the end of the year. So today it's the turn of gas, and my colleague Laszlo Varro will take you through the details of the report, but I would like to highlight 3 key trends. 3 years ago, IEA introduced the concept of natural gas entering a golden age, and the first point I want to highlight today is that the golden age of gas has arrived in China. The recently signed supply deal with Russia is actually only a relatively small part of the story, and one that will take some time to come on stream. No, the main story here is domestic demand that will nearly double over the next 5 years to top 300 BCM, driven by pollution concerns and more generally by economic growth. And gas is expected to see major growth right across the Chinese economy, not just as a substitute for coal in the power sector, but also in the residential, industry and transport sectors. But of course the big question is, where are they going to get this gas from? The single biggest new supply source in China is domestic production, which is set to grow from 117 BCM in 2013 to 193 BCM in 2019, and that's a rise of 65%. Well, that's enough to meet half of China's demand growth over the period. There is also a massive expansion of coal gasification, which highlights the trade-offs for energy policy, as this domestic resource, as we all know, has a very high carbon footprint. And this is a major shift. And yet China will clearly remain a growing importer. And we also expect that strong domestic supply, expanding infrastructure links domestically and with Central Asia, and further out, Russian piped gas will again change the dynamics of the globally traded market for LNG. Now, the second point I want to make is that this report is little opportunity for Europe to diversify its gas supply by the end of the decade. Demand also remains flat, with recovery to its 2010 peak of 567 BCM not expected at any time to 2019. And we all know that recent talk of plentiful LNG being available from the US shale boom is simplistic. The necessary export facilities are not yet in place, and we must remember that gas is an expensive fuel to transport and is sold into a global market dominated by current high prices in Asia. And in fact, with currently weak European demand and Russian gas, there is the guarantee of gas supply to Asia as major utilities redirect their LNG from Europe to the east. But of course, this may well change. Big Australian projects will expand supply to Asia, but the race is on to keep up with demand growth there. And other energy projects will predominantly require more than 5 years to come on stream due to the combination of policy barriers and investment lead times. And I'm afraid this is true for most Canadian projects as well. Now, my third and final headline for you is that North America and Australia will account for 40% of additional supply and a large majority of the expansion of international trade. Given the abundance of gas in the domestic market, The recovery of gas production in Canada will be conditional on finding new markets for that gas, either in Asia in the form of LNG or domestically in the transportation sector. One of the key drivers for the massive and rapid expansion of the sector within these economies has been the private sector's ability to raise capital. And in dollar terms, more upstream investment is flowing to North America than to the Middle East and Russia combined. We are entering an age of much more efficient natural gas markets with additional benefits for energy security. And while demand growth is driven by the Asia-Pacific, especially China, supply growth for the international gas trade is dominated by private investments in LNG in Australia and North America. And yet, this projection comes with a caveat. Pricing. Pricing will be key. High LNG prices are threatening to crimp demand as many countries are increasingly unwilling or unable to afford these supplies. And that could open the door to coal. So looking ahead, unless we see timely investment in new production and LNG facilities and the reversal of the recent cost inflation of LNG, only a very strong climate policy commitment could redirect Asia's coal investment wave to gas. So with that, I would now like to hand over to our head of gas, coal and power markets, Laszlo Varro. Laszlo, the floor is yours.
Thank you very much, Ms. van der Hoeven. Ladies and gentlemen, I'm going to go now into the specific details of the report. And let's start with China, which, as Ms. van der Hoeven emphasized, is the biggest component of global gas consumption growth. Up until today, the Chinese energy system has been dominated by coal. This is very well known, but what is also quite important is that China has a coal usage structure which is very, very different from what we can observe in Europe and the United States. In industrialized market economies, 97% of the coal is used in just two sectors of the economy, power generation and steel making. These are the modern 21st century usages of coal. Coal has disappeared from every other sector of the economy decades ago. Now, these two sectors, power generation and steel, account only for 75% of the Chinese coal usage. So 25% of Chinese coal is used in sectors like using coal in textile manufacturing, using coal in the food industry, heating buildings with coal in a 19th century fashion. And this 25th century represents a disproportionate share of the air pollution problem in China. For power generation, a modern gigawatt-scale coal-fired power plant can be equipped with electrostatic filters and flue gas desulfurization to cut down local air pollution to a minimum level. And some of the new Chinese coal-fired power plants are among the best. But if you heat buildings with coal or if you use coal in a factory, there is no way to avoid a serious air pollution problem. And this is important to understand why the usage of gas in China and the role of gas in China is so different than in many other regions. Typically, gas-fired power generation is the single most important driver of gas demand. Now, that is growing in China, and we foresee around 10 gigawatts of modern gas turbine power plants being built in China every year. But given that China has over 1,000 gigawatts power generation capacity, this actually does not play a major role in the Chinese electricity sector. In fact, nuclear power, hydropower, wind and solar plays a much, much bigger role in improving the environmental performance of the electricity sector in China. On the other hand, natural gas is making very, very quick inroads into the 25% of old-fashioned coal use, where natural gas replaced coal 50 years ago in advanced market economies. Very importantly, China is the only one of the key big emerging market countries with rapidly growing energy demand, which has cold winters. There is no need for winter heating in India, Indonesia, Brazil, or South Africa, but northern China has very cold winters. So residential gas consumption for building heating is growing quite robustly in China. Gas use is taking up in the Chinese industry, replacing coal in industrial boilers and industrial processes. And I should also emphasize the role of gas in the Chinese transportation sector, because with a natural gas engine, the sulfur dioxide and particulate emissions of diesel engines are almost completely eliminated. And given the air pollution problem of major Chinese cities, this is a very, very important policy objective. So China represents almost 1/3 of the global gas demand growth in the next 5 years to come. Now, Europe is at the other end of the scale. In Europe, European countries introduced very ambitious and very strongly supported renewable policies. There have been some cutbacks here and there, but by and large, renewables in Europe are still in a very robust, very strong growth path. In fact, renewable electricity production in Europe is growing more rapidly than electricity demand. Consequently, in every year in which Europe does not close down a nuclear power plant, the need for conventional power generation declines because renewables provide more than demand growth. We had a major negative revision for our projections on Europe because we realized that gas will continue to face multiple challenges, very weak growth of electricity consumption, even in fact, in several important countries, even ones that recover very nicely from the financial crisis like Germany, electricity consumption is stagnating at well below the pre-financial crisis level. The demand weakness accompanied with a continuous strong growth of renewables and the continuous robust competitiveness of coal. In the projection time horizon, we don't see deep enough reforms in the European emission trading system, which would lead to a carbon price that would significantly change the competitive dynamism between coal and gas. Now, Europe will decommission some old coal-fired power plants due to other environmental regulations. So the total coal-fired power generation capacity will go down, and that will limit coal usage. But the remaining coal-fired power plants will remain robustly competitive. And at the same time, on the upstream side, European gas production is falling, and we don't see a realistic chance for shale gas in Europe to turn around this negative trend. Consequently, even with a stagnating demand, Europe needs very large import sources. And given the look around the alternatives, the North Africa is unlikely to be able to increase gas exports to Europe because of rapidly growing domestic demand and stagnating production. LNG markets are very tight, and they will remain tight up until the current large investment wave in Australia and North America materializes. Norway will be able to increase its production, but to a degree which is insufficient to compensate for declines elsewhere in Europe. Consequently, we don't see any meaningful reduction in European reliance on Russian gas. In fact, under very realistic assumptions, by the end of the decade, Europe could import roughly as much LNG from North America as the decline of European production. Consequently, North American LNG will replace domestic North Sea gas, and the reliance on other non-European suppliers will not diminish. Now, I already mentioned some concerns and problems in North Africa, where gas is facing a triple set of challenges. On one side, some major gas producers in North Africa, like Algeria, Egypt, and Libya, face significant security problems. We have witnessed various terrorist and insurgent attacks on gas infrastructure facilities, and of course, this is detrimental to production and investment. But perhaps even more important than the security situation is energy policy. That in almost all of the North African producers, governments set regulated gas prices at an unrealistically low level. That hinders upstream investment, and that generates excessive consumption inflated by the subsidies. In fact, in Egypt and also in Saudi Arabia, in the Middle East, an average gas-fired power plant consumes around twice as much gas for a kilowatt-hour of electricity than what is a current best technology for gas-fired power generation. So this is a very wasteful consumption structure. Having said that, we see a continuous demand growth in Africa, dominated by the conventional users of Egypt and Algeria, but we see a very important upswing in the other regions of Africa, where the availability of gas will enable governments to go for electrification. So that is taking place in in Ghana that is taking place, in Nigeria, also Mozambique. So increasingly the upstream of domestic upstream is also used for providing electricity domestically. Now, in the past 5 years, natural gas was the only major business in the world economy which resisted globalization. In fact, globalization was actually reversed, because while 5 years ago gas prices were reasonably close in the main regions, we have seen an amazing degree of disconnection in the past 5 years. Now, in our methodology, we don't try to forecast prices. We base our analysis on forward prices. Forward prices indicate a continuous divergence. With North America benefiting from low gas prices and abundant shale gas production, Europe somewhere in the middle, and in the Asia Pacific, very expensive oil price index contracts lock in a high price structure. Now, several countries in the Asia Pacific are considering the development of LNG trading hubs and gas and competitive gas markets. We very much encourage these policies, but realistically, we don't think that within 5 years a Henry Hub type liquid gas trading will emerge in Asia that will provide a credible alternative to oil price indexation. That will require some deeper policy measures and pricing reforms. Now, the overall revision compared to last year's report was negative. So we revised our 5-year projection somewhat down compared to the previous medium-term report. I already mentioned the revision in Europe, and the other region where we had a big negative revision is the former Soviet Union, where energy efficiency finally started to improve in the Russian economy. This is a very good news. Whereas in the case of Ukraine, if the gas consumption is falling, some of the reasons are good, some of the reasons are bad. The good reason is that Ukraine started to make progress in reducing subsidies and improving energy efficiency. Of course, the bad news is that due to the political and financial situation, the Ukrainian economy is in a very bad shape. But due to the big negative revisions for the former Soviet Union and Europe, our overall consumption number was revised down by around 70 billion cubic meters. And the second biggest growth region is the Middle East. We traditionally thinking about the Middle East as a producing region, and certainly they are a very large gas producer. But we foresee a declining gas import from the Middle East, because domestic demand in the Middle East is growing so robustly that upstream will not be able to keep up. And by the way, even with this robust growth of domestic gas production, there will be only a very small dent in the use of oil in power generation in the Middle East. So we project that the share of gas in power generation will go up from 60 to 62% only in the Middle East. And oil-fired power generation in countries like Saudi Arabia and Iraq will continue to increase. Now, where the supply will come from? The biggest incremental supply growth will come from North America. So for shale gas, what we have seen so far is only a taste of things to come. We are increasingly optimistic about the ability of the U.S. gas industry and the Canadian gas industry to maintain gas production growth in the face of low prices due to two factors. One of them is economics, another is engineering. The economics factor is that the industry is very smartly adopting its business portfolio to take advantage of the financial boost from natural gas liquids, and that's increasingly a core part of the business model of the U.S. gas industry. And the technical part is that there is an impressive technological progress in the U.S. gas upstream in terms of better 3D seismics, more precise drilling, better targeted fracking. So the drilling times are declining, the capital costs are declining, the flow rates are improving, and the decline rates are also less serious than they used to be. So North America is robustly going ahead. The Middle East is going to provide a very large production upswing, but as I emphasized, more than 100% of that production growth will be absorbed by a very rapidly growing domestic consumption, so exports actually decline. And we should not forget the domestic upstream of China, which is also very, very meaningful. This decade, coal gasification, synthetic natural gas production from coal will actually play a more important role in China than shale gas. But China is also moving to commercial scale shale gas production within this decade. Now, at the same time, of course, the Chinese and the Middle Eastern production growth will serve domestic purposes. So in international trade, a disproportionate role will be played by the OECD regions, namely Australia and North America. In Australia, the investments are already going ahead full speed, whereas in North America, several LNG projects received their approval from the Department of Energy and also, in the case of Canada, from the Canadian authorities. But only one project, the Sabine Pass project by Chineri Energy, is actually under construction. Now, we shall see to what extent the project management and cost management aspects of the North American LNG projects will prove to be favorable. That is going to be a major challenge for the industry to manage adequately. Nevertheless, we do foresee the United States emerging as a significant, meaningful LNG exporter. And very importantly, the U.S. LNG projects have a very different business model, no oil price indexation, no destination clauses, so it's going to play a disproportionate role in developing efficient, competitive gas markets. The large majority of the LNG projects that are under construction have already been contracted by the major utilities in the Asia Pacific. There I would highlight the role of three important countries: Japan, Korea, and China. In the case of Japan, we don't see a further growth in Japanese gas consumption. The Japanese government initiated a throughout review of their nuclear capacities, and they emphasized the importance to restore and maintain nuclear power as a component of Japanese energy supply. Of course, the exact schedule of the restart of the nuclear reactors in Japan is uncertain. In this report, we took a very cautious approach of basically assuming that by the end of the decade, we recover less than half of the pre-earthquake level for nuclear production in Japan. But even that will be sufficient to reduce oil-fired power generation in Japan and stabilize gas imports at the current level. In fact, last year, Japanese gas imports were already stagnating. The big increase was in 2011 and 2012. So we don't foresee further growth from Japan, but we do foresee is that Japan has today a very large reliance on Indonesian LNG, and in the case of Indonesia, it is very, very questionable whether Indonesia could maintain the current LNG export level in the face of very rapidly growing demand and domestic production decline. So in the case of Japan, it's more of a rearranging of the LNG import portfolio rather than absolute growth. In the case of Korea, Korea has a very healthy GDP growth and a rapid growth of energy consumption. But Korea also has an ambitious nuclear program, and taking advantage of the much more favorable price of coal to gas, there are roughly 10 large coal-fired power plants under construction in Korea, which will of course limit gas demand. So that will leave us with the third big source of LNG demand, China. But of course, whereas Japan and China have isolated energy systems and no good domestic alternatives, none of that is true for China. China has a significant growth of domestic upstream, and China has a well-diversified pipeline imports from Turkmenistan, Uzbekistan, soon from Russia, and also from Myanmar. So China will increase its LNG imports. We project a 57 billion cubic meters LNG imports to China. But those LNG imports will arrive into an increasingly competitive, increasingly well-diversified Chinese gas market. And then a last word about Canada, because we are launching this report in the Forum of the Americas from Montreal. Canada has huge gas resources. In fact, the gas resources of Canada are infinite for all practical purposes. However, it is also very, very clear that the conventional business model of Canada, namely that we produce the hydrocarbons and we send everything down to south and the United States will buy it, that conventional business model does not work anymore because there is a very, very dynamic upswing of U.S. domestic production. In fact, some pipelines that were originally built to export Canadian gas to the United States are now being reversed and they bring back gas from the United States to Canada. So the current structure of the Canadian economy will not consume the Canadian gas resources for at least a century. Consequently, if the Canadian industry does not want to keep that gas underground for a century, there is need to find new gas markets. The one possibility is using gas in heavy-duty transportation as a transportation fuel. Several Canadian companies are working on it, and this is certainly a very attractive option. And the other is to build up the export capacities to the Pacific Ocean. Now, there are some good news and there are some bad news for the Canadian industry. The good news is that the Pacific coast of Canada is much, much closer to the Asia-Pacific than the Gulf Coast of the United States. In the United States, most of the LNG projects will be in the Gulf Coast. Now, even if after the Panama Canal expansion, the tankers go through the Panama Canal, the Pacific coast of Canada will have a more than 5,000 kilometers advantage in shipping distance. That's a very significant advantage. The bad news is that the Canadian LNG projects are not easy. They are not easy from a technical point of view because the pipelines have to cross mountains and difficult geographical areas, and they are not easy from a licensing point of view either because there are very tight environmental regulations, First Nations, and other licensing issues. So this is going to be a major challenge, but we believe that if the industry is capable of tackling these challenges, then these projects can be very, very competitive. So with that, I would pass the floor to Greg for the Q&A.
Thanks very much, Laszlo. We will now turn it over to your questions. Ms. van der Hoeven regrettably must go to her next speaking engagement here at the Conference of Montreal, but Laszlo will reply to all questions that come through. And if you need a quote from Ms. van der Hoeven, you're welcome to email the IEA press office afterward, and we will arrange for something for you. Thank you.
Thank you. As a reminder, if you wish to ask a question, you may either press star 1 on your telephone to ask a question over the phone lines. Alternatively, you can submit your question via the Q&A box on the chat facility. The first question comes from the line of William Powell from Platts. Please ask your question.
Good afternoon, and thank you very much for the explanation of your report. I had a couple of questions. First of all, Maria van Hoeven said that only China showed signs of having enjoyed the golden age of gas. I was wondering whether you thought other countries might get there in due course. And also, given that you've revised downwards your annual growth rate for gas demand for the last 2 or 3 years, do you think that it may be further revised downwards next year? Thank you very much.
Okay. Well, it's not only China who enjoys the golden age of gas. The golden age of gas is actually at full swing in North America. In fact, if you take our original golden age of gas report from 3 years ago, our current projections are much more optimistic for that. So the United States is beyond the golden age. But this golden age is arriving now to China as well. Which other countries can take advantage? That very much depends on two things. One, the development of domestic, the development of domestic non-conventional upstream, and the second is the development in international gas markets. Because you either need an abundant gas supply for a golden age of gas domestically, or you need a well-diversified, cost-efficient, and nicely functioning gas infrastructure. So I would say one good candidate is Mexico, where the current energy sector reforms, I believe they are very, very exciting, and they have a potential to transform Mexico into a country which currently relies on very expensive gas imports into a very large producer, and gas would play a very important role in that. That would of course require the Mexican government putting all the details of the reform in place. I think another strong candidate is Argentina, which has Argentina is the country where the geology of the shale resources is probably better even than in the United States. But of course, in the past decade, various private investors had not always happy adventures investing in Argentina. So Argentina needs to provide a much stronger, much more investor-friendly regulatory environment for the golden age of gas to really pick up. And arguably, Russia always had a golden age of gas. So they have limitless gas resources. Gas plays a very large role in the Russian domestic energy system. Up until today, they have been using it very, very inefficiently. As I mentioned, energy efficiency is improving in the Russian economy. That's a good news. And Russia, not very rapidly, but will emerge as a meaningful gas supplier to the Asia Pacific as well. So there are some other countries who are also participating in that. Now, whether we will revise our projections down again, time will tell. We always base our projections on the best and most up-to-date information that is available. But of course, we always try to apply some common sense filter. So we don't take the corporate assessment. We don't take the corporate announcements about project timing at face value. So you could have things which a company announced that they will come online in 2018, and we say that it's not going to come online in the next 5 years, because we try to also assess the difficulties of project management as well.
Thank you very much.
And the next question comes from the line of Mark Smedley from Energy Intelligence. Please ask your question.
Hello, Laszlo. Thank you very much for the very comprehensive report. I'd like to look at Europe. We've seen a lot of demand destruction, as it were. I don't know whether you'd agree with that term. But recently, that seems to have had an impact on prices. Your report has noted that just after the winter we're seeing $8 per million BTU. This week we've actually seen prices going almost to $6 for very prompt gas. And I just wondered whether you see that trend continuing to any degree. I mean, has the price of short-term gas reached its limit? Can it fall further? And what impact do you think this is going to have on long-term pricing? Because obviously there's been a move towards hub indexation for long-term contracts. I noticed you quote the SocGen analysis saying more than half is hub indexed. Does the IA now have an estimate as to how much in Europe today, because that SocGen analysis was 2013, how much now is spot-linked continent-wide in 2014?
Well, in general, we don't try to forecast prices.
Yes.
We leave that to the investment bank analysts.
Okay.
But we base our analysis on the forward curves.
Yeah.
Now, at the same time, of course, at the time of modeling this report, we took a forward price curve from that time, which was around $10. We assessed the markets and we modeled demand with those prices, and with those prices, gas will continue to be squeezed out, and gas consumption will not recover in Europe. And given that on the policy side, we don't see a prospect of a carbon price in Europe which is high enough to restore the competitiveness of expensive gas in the European energy system. That essentially means that anybody who is selling gas in Europe faces the strategic dilemma of the airline industry, namely that you can try to sell expensive business class tickets, but not a lot of them, or you can sell cheap low frill tickets, but a lot of them, because at the $10 plus price level, gas is continuing to be squeezed out, and the demand destruction, as you said, will continue. Now, what we observe is that different gas exporters to Europe have different strategies in this respect. Some of them embraced market liberalization and completely changed their sales portfolio to hub sales. Some of them apply a mixed strategy, and they are happy to sell less to maintain premium prices, and yet others insist on oil price indexation even today. Now, we don't want to tell those gas exporters what to do, because that's their gas. It is their sovereign right to decide on their pricing strategy. But certainly, we don't see a bright role for expensive gas in the European energy system. As for the hub pricing, I think I would not like to pinpoint a very precise number of either the 52% or 58%. What is more important is that in the case of MBP and TTF, we are now talking about real markets. One criticism that was often said about European gas markets by the major exporters who insisted on oil price indexation was that these European gas markets are not liquid, they don't provide a reliable price signal, and so on. And up until recently, there was an element of truth in that. This was a long process to develop properly functioning gas markets in Europe. In the case of MBP and TTF, we believe that these are proper markets in the microeconomic sense, who provide reliable price signals and guide markets. So we don't think that oil criticism is valid anymore.
Thanks very much. Thank you.
Once again, if you wish to ask a question over the phone lines, please press star 1 on your telephone and wait for your name to be announced. If you wish to submit your question via the WebEx, please do so via the question and answer box. The next question comes from the line of Michael Lelleveld from Radio Free Asia. Please ask your question.
Yes, hi. Thank you for your presentation. And I wonder if you could address the question about China and its low coal prices. It seems that you get low coal prices no matter what happens. If you have more shale gas production, it drives the price of coal down further and creates competitive pressure. And low coal prices seem to be a fact of life, and competitive pressure seems to be a fact of life. How is this going to be managed in China to promote adoption of natural gas in the power production and in industry?
Well, that's a very good question. In fact, indeed, coal is cheap, and the reason why coal is cheap is not shale gas in the United States and U.S. coal exports. Coal is cheap because we have so much of it. And coal is incredibly abundant. It is geopolitically very well distributed. You can mine it anywhere from northern China to Australia at very reasonable cost. So you are perfectly right. Coal on the basis of costs only, coal will continue to have a major economic advantage over pretty much any other energy source. And outside North America and the Middle East, it will certainly have an economic advantage over gas. Now, so how gas will prosper? Well, first thing to keep in mind is that we don't believe that natural gas will play as big role in the power generation sector of China as it does in the United States. Okay. I mean, in the United States, natural gas is currently around 25% of power generation. In China, it's around 3 or 4, and we don't think it will go over 10. And coal will remain a very, very important energy source in China for decades to come. So that's the first thing, that natural gas will not defeat coal in the conventional sense that is bigger than coal. But natural gas will make very, very important inroads in those applications where the use of coal might be cheap, but it creates unacceptable environmental pollution. So essentially, a society will have to pay an additional investment cost and additional energy cost in order to clean up the air. That happened in the United States and Europe in the 1970s, 1980s, with the U.S. Clean Air Act, with the European sulfur dioxide regulations, and so on. I mean, those environmental regulations had a real economic cost, but had a very, very large environmental benefit. Now, China is right now approaching the stage of development when the environmental problems are very, very serious, and the Chinese society and the Chinese government is very determined to do something about it. So these projections are based on the assumption that China is willing to commit real resources into cleaning up the environment, but that's our impression about the new Chinese government and their energy policy.
And the next question comes from the line of Oleg Bukmanovich from Reuters. Please ask your question.
Oh, hello, Laszlo. Thank you very much for the presentation. I had a question centered around Europe, and we've seen Gazprom giving out quite steep gas price discounts to its European clients. And a few weeks ago, we saw Gazprom give Eni its first non-oil indexed gas contract, as well as quite a lot of makeup gas from previous years, which it didn't use under take-or-pay. So at the same time, Gazprom has pushed out more supply into Europe. My question is, with the impact this has had on prices and making gas more profitable, although not absolutely profitable compared to other fuels, what impact will this have on new supply projects in the Caspian, in the Eastern Mediterranean, in Europe's ability to attract new supply that isn't Russian gas? Thank you.
Sure. The overwhelming majority of Russian gas exports are coming from fields and through infrastructure where the capital is already in. So Gazprom very successfully did the Boban and Kovo field development in the past 5 years, but the production in Boban and Kovo is actually roughly half of what was originally envisaged in the field development plan, which means that they can very rapidly and very easily ramp up production in Boban and Kovo if that's what they want. And of course, within Russia itself, Rosneft and Novatek, the two other Russian majors, have very rapidly growing gas production, and they are increasing their share in the Russian domestic market. So there is no doubt that if Gazprom wants to sell more gas in Europe, they can do it at a very, very low marginal cost. And given that the Nord Stream pipeline is half empty, they also have an already existing infrastructure to deliver it. So I think the type of agreements that you refer to make perfect strategic sense from a Gazprom point of view, because that maintains their position in European gas markets. This is exactly this airline strategic dilemma that I refer to in the question of plots. Now, certainly, the lower the price of gas in Europe, the less attractive the diversification project will be. Now, of the major diversification projects, I would say that the Chardonnay's project for bringing Azerbaijani gas to southern Italy, that already received final investment decision. And of course, Chardonnay's contains a substantial amount of liquids, which will very powerfully help the economics of the project. So I'm not worried about Chardonnay's. I think that will continue and that will go ahead. For the Eastern Mediterranean, our impression is that the key obstacle for project development is not economics. The key obstacle is various international relations and legal issues. So it is essentially up to the governments of the region to create a proper legal framework where development can go ahead. Now, this can happen tomorrow, or this can take several years, depending on how the relations between the key governments evolve. But we believe that once the appropriate legal framework is in place, there the development will go ahead. But of course, for example, in the case of Israel, there is absolutely no guarantee that that gas will go to Europe. In fact, there is right now an ongoing policy discussion in Israel of what to do with that gas, whether to use it in the domestic economy, whether to use it to produce fresh water with desalination, whether to export it to Jordan and Lebanon and so on. Europe is only one of the options. Whereas for LNG, what we see is that LNG markets increasingly is globalized. So if you have a lower price level in Europe, then less LNG comes to Europe and more LNG goes to Asia. But if the LNG supply is there, now I don't think that there are European utilities, at least privately owned utilities, who would be willing to pay a financial premium for North American LNG over European market prices. So if North American LNG is available at prices below the European market prices, so much the better. If not, it will go to Asia. But the existence of that flexible and geopolitically secure LNG supply will be a major improvement, because that essentially means that if there is any supply disruption to Europe and prices do go up, in that case, that LNG will come to Europe, which today would not. Today there would be no guarantee for that, given the tightness of LNG market. So you could have a much more competitive market and a much better energy security, even if Europe continues to use large quantities of Russian gas. In fact, we believe that Europe will continue to use large quantities of Russian gas for decades.
Thank you.
There are no further questions from the phone lines at this time. Please continue.
If there are no further questions, then that will conclude today's webinar on the gas market report. I'd like to note two things. One is that many materials are related to this report are available on our website at www.iea.org. These include the slides that were presented today, Mrs. Vanderhoven's opening remarks, a fact sheet, the executive summary of the book, as well as the press release. The second thing to note is that a week from today, we will be launching our medium-term oil market report, also by webinar. If you have not registered for that and are interested, please send an email to ieapressoffice@iea.org. Thank you very much.